C. Detect and mitigate fraud, such as payments, bank transactions, internal, external. Fraud detection and mitigation are critical Treasury responsibilities because financial crimes can result in significant monetary losses, operational disruption, reputational damage, and regulatory consequences for organizations. Treasury professionals are responsible for identifying vulnerabilities within payment systems, banking processes, and operational workflows that may expose the organization to fraudulent activity. Fraud risks may originate internally through employee misconduct or externally through cybercriminals, counterfeit transactions, phishing attacks, or unauthorized banking activity. Treasury teams establish controls, monitoring procedures, and governance frameworks to reduce the likelihood of fraud and strengthen operational security. Effective fraud management requires continuous oversight of payment activity, banking relationships, and transaction authorization processes. Treasury professionals must remain vigilant as fraud techniques evolve alongside digital banking technologies and global financial systems. Payment fraud represents one of the most common Treasury risks because organizations process large transaction volumes across multiple banking channels and payment methods. Treasury professionals monitor wire transfers, ACH payments, checks, card transactions, and electronic payment platforms to identify unusual activity or unauthorized transactions. Fraudulent schemes may involve business email compromise, vendor impersonation, payment redirection requests, or counterfeit payment instruments. Treasury teams implement controls such as dual authorization, segregation of duties, payment limits, callback verification procedures, and positive pay systems to reduce payment fraud exposure. Treasury management systems and automated monitoring tools also support real-time detection of suspicious activity. Strong payment controls improve transaction integrity, reduce operational risk, and strengthen confidence in organizational financial processes and Treasury operations. Bank transaction fraud can occur through unauthorized account access, fraudulent account changes, counterfeit checks, unauthorized wire instructions, or manipulation of banking credentials. Treasury professionals work closely with banking partners to establish secure account controls, transaction monitoring systems, and fraud reporting procedures. Treasury teams review daily account activity, bank reconciliations, exception reports, and electronic banking access logs to identify unusual transactions promptly. Multi-factor authentication, encrypted communications, restricted user access, and secure banking platforms help reduce exposure to unauthorized banking activity. Treasury professionals also maintain close communication with banks regarding emerging fraud threats and suspicious transaction patterns. Effective oversight of banking activity strengthens operational security and helps organizations respond quickly to potential fraud incidents before losses escalate significantly. Internal fraud risks often involve employees or contractors exploiting access to financial systems, payment authority, or confidential information for personal gain. Treasury professionals mitigate these risks through strong internal controls, employee oversight, and operational governance practices. Segregation of duties is especially important because no individual should control an entire financial transaction process from initiation to reconciliation. Treasury teams implement authorization hierarchies, access restrictions, independent reviews, and mandatory approval procedures to reduce opportunities for misconduct. Regular audits, employee background checks, and rotation of responsibilities also strengthen internal fraud prevention efforts. Treasury professionals encourage ethical behavior and compliance awareness throughout the organization to support a culture of accountability and reduce the likelihood of fraudulent activity within Treasury operations. External fraud threats continue to increase as cyber criminals use advanced technology and social engineering techniques to target organizations and financial institutions. Treasury professionals must understand cybersecurity risks associated with email systems, payment networks, electronic banking platforms, and third-party service providers. Phishing attacks, ransomware incidents, malware infections, and credential theft can compromise sensitive financial information and disrupt Treasury operations. Treasury teams collaborate with information technology, cybersecurity, legal, and compliance departments to strengthen digital security controls and incident response procedures. Employee training programs help staff recognize suspicious communications and avoid fraudulent requests. Effective cybersecurity awareness and coordination improve the organization's ability to detect, respond to, and recover from external fraud attempts and operational disruptions. Fraud detection also relies heavily on monitoring systems, exception reporting, and data analytics that identify unusual transaction patterns or operational irregularities. Treasury professionals use treasury management systems, payment monitoring tools, and reconciliation processes to evaluate transaction activity and flag anomalies for investigation. Automated alerts may identify duplicate payments, abnormal transaction amounts, unusual payment destinations, or unauthorized system access attempts. Treasury teams analyze operational trends and historical transaction patterns to improve fraud detection accuracy and reduce false positives. Timely investigation and escalation procedures are critical because rapid response can limit financial losses and prevent additional fraudulent activity. Effective monitoring strengthens operational visibility and supports proactive fraud risk management throughout treasury and financial operations.